Okay, I'm very excited to have on the Goldstein on Gelt show Meb Faber, who is the Chief Investment Officer of Cambria Investment Management, and he's the host of the Meb Faber Show. He's written a number of books on investing. Meb, as an investment manager, I'm sure you've heard the question that comes up a lot. People say, what do I need a manager to manage my funds for? I can just throw all the money into an ETF, some exchange-traded fund or index fund. What do you say when someone says that?
Well, usually I say that's great advice because we manage ETFs, but seriously, is that, one of the reasons the entire investment management industry exists is the same reason having a trainer exists, is because the formula and what the advice is for what you should do and the ways to invest is actually pretty simple. But the biggest challenge in investing is not the actual implementation, it's how do we keep our human nature from mucking things up, from getting into the way. And so, evolution over millions of years has not prepared humans for trading, shares of IBM and Google and currencies and real estate and everything else. It's really prepared us for the savannah, and from the standpoint of no one ever runs towards the tiger. And it's the same thing with investing, is that having an advisor, as long as you don't pay too much for that type of advisor, it can be a sound investment. It's even better if you can do it on your own, but many people can't.
What's funny about doing it on your own? I run across a lot of times people who, they don't even know how to balance their checkbook, for example. They don't even know the very, very basics of investing. And then you come along and say, listen, why don't you design a portfolio that's diversified? And you can do it with ETFs. So, for someone who's been in the field for a while, that's not the most complicated thing in the world. But I'm not really sure that people are prepared to handle the money by just reading a couple of articles in Kiplinger's.
There's a big education gap, and it's a shame because at least in the U.S., they don't teach personal finance and investing in high school or college. And so it really has to be self-taught for a lot of people. And the challenge then is that most people learn by experience. And many investing scenarios or regimes can go on for decades. So think about, 20 plus bull market in the U.S. in the 1980s and 90s, followed by two huge bear markets. Well, the people that grew up during those times had very different experiences. And so they took away very different lessons. And if you talk to somebody during the Great Depression, very different takeaways. And so you have to spend a lot of time with history. To really be a student of markets, you have to understand history and what's possible. So not only the averages, but both the best and worst case as well. And that's really hard. That we think on a time frame of the news cycle of weeks and months, maybe quarters, even years, whereas most of the investment time frame, you're really planning for 5, 10, even multiple decades on out.
I think that is a big issue, that people don't even understand what long-term really means. And back to the education point, one of the things I find is funny is when I was in school, in high school and in college, I studied calculus and advanced calculus. And frankly, I don't really remember much of what I studied then. But kids, instead of spending the time studying, except for the engineers, right? Instead of spending the time studying this kind of esoteric math, the kids could have studied stocks and bonds and calculating yields. There's certainly plenty of math to learn by doing that. And then they'd walk out of school actually knowing something that would be applicable for almost everyone in his life, instead of just for the very few people who actually need to have calculus. But lucky they have guys like you on the podcast world who can share some of the ideas. One of the issues that I think comes up, another area that people can't really put their hands around, is this concept of risk tolerance. We talk all the time about, you should only buy what you're comfortable with, but you can't put a number on it. How do people really determine what their risk tolerance is in order to set up an intelligent portfolio?
We call it the sleep at night factor. Once you get this base case level of understanding and history, and here's a very simple overview. Global stocks historically have done about 9% a year since 1900. Bonds down around 5%, and bills or short-term cash around 4%, and that has inflation of about 3%. However, like we mentioned in the U.S. in the Great Depression, the U.S. went through an 80+% bear market. So you have to be prepared. The simple arithmetic would be put all your money in stocks, you'll get 9% a year because that's the winner. But you have these times where you go through these bear markets where you lose half or even more. You have a couple other examples where entire countries' stock markets went away. So China, Russia, both due to communist regimes, as well as other countries like Argentina and Egypt, where essentially you lost all of your assets in the stock market. So what do people typically do? They diversify into bonds, they diversify into cash as well. And what we recommend is also some real assets. So think about real estate, or commodities. And then once you have this blended portfolio, it's really only putting as much at risk as you're willing to sleep at night. So we often tell people the best way to minimize risk is to not take it in the first place. So until you really feel comfortable, and we have a great book on this, Global Asset Allocation, that shows how these diversified portfolios would have done over the past 40 years. And so for many people, they learn their lesson the wrong way, where they invest too much and then lose too much and then are forever scarred. So what we often tell people is to really think about and look at history, find out what you're comfortable with, and then certainly err on the side of caution rather than being aggressive.
We're speaking with Meb Faber, who is the Chief Investment Officer at Cambria Investment Management. He also hosts the Meb Faber Show. Meb, you've been talking to us about many different types of investments. You listed a number of different asset classes, stocks and bonds, real assets. What would you say is the biggest risk that an investor should be prepared for?
Each asset class, it has the time where it shines and where it does terrible. And the biggest advice I give is not becoming too wedded to one asset or investment. There's a lot of people out there to say, hey, I'm a dividend guy, or I'm a fixed income investor, or, I put all my money in real estate, and that's fine. If you're an expert in those areas, but in general, people become too wedded to an asset. They usually start chasing performance, meaning, we're having one of the longest bull markets we've ever had in the U.S. right now. And this is a great example because historically, investing in the U.S. stock market versus a global market is a coin flip. 50-50 performance, one outperforms the other. The U.S. has one of the biggest outperformances you've ever seen in history over the past 8 years. And a lot of the foreign markets have really underperformed. So a sensible thing to do is to diversify into foreign markets. And as a part of the entire global picture, the U.S. being the biggest economy is only about half the world's stock market. So most people should have half in foreign markets that are domestically located here in the U.S., but no one does. Most of the Americans put 70% in their own market, which is called home country bias. This also happens, though, in every country around the world. Mm-hmm. So most of the Italians put most of their money in their own stock market. Most of the Aussies do the same thing, and I'm sure in Israel most people do the same thing. And that's a really bad thing to do because you end up with this massive concentration, and you can ask anybody that's been in Greece or Cyprus or Russia over the past few years that have had these huge losses. It's a really, really suboptimal way to invest.
Well, what about like currency risk? Because if you live in the United States, for example, kind of makes sense you should be a dollar-denominated investor, no?
Yeah, most people in the U.S. don't think that much about currencies. And I travel around the world, and most of my friends in other countries think a lot more about currencies, and part of that has to do with the reserve nature. So, it is our belief that real currency returns over time are fairly stable, and that means they adjust for inflation over time. Keyword being over time. Any given year, currency could go up, down 10, 20, 30%. And so my advice has always been to, either you hedge the currency investments or you don't, but you don't switch back and forth. And that's really where people get into trouble, is trying to time the currency investments. So really you just pick one and stick with it. And in general, it balances out over time. But that's one of the biggest benefits of investing internationally for everyone, is that you get the global market average rather than an outlier for either better or worse.
Yeah, one of the things that I tell people who live in Israel, for example, and where they're dealing a lot in shekels, is I'll say, you really have two currencies that you deal with. One of them is your reference currency, and the other one is your living currency. Because when I sit down with a client in my day job as a financial advisor, and I say, how much is your net worth? More often than not, I'll hear it's worth $1 million as opposed to it's worth, I'm worth 1 million shekels, because that's their reference currency. And even though they may have been living in Israel for decades and everything they buy in the grocery stores is in shekels, it doesn't necessarily mean that they should put all of their money in shekels or keep it all in dollars just because they think that way. Meb, this is actually very interesting. I know you cover a lot more on your podcast as well as in your books. Unfortunately, we are just about out of time now. In the last few seconds, could you tell people how they can follow you and follow your work?
Sure. So I've written over 1,000 investment articles on my blog at mebfaber.com. You can see any of our 5 books I've written, as well as white papers on Amazon, as well as the blog. Our company's website is Cambria Funds or Cambria Investments. And lastly, you can watch me pick fights and chat more on Twitter at Meb Faber.
All right, we will put links to all of that at the show notes of today's show at goldsteinongelt.com. Meb Faber, thanks so much for your time.
Been a blast. Thank you.
You've been listening to the Goldstein on Gelt show with money maven Doug Goldstein. Check out all of Doug's money ideas at goldsteinongelt.com. Doug specializes in helping people who live outside the United States handle their U.S. investment accounts. If you have a question that you would like answered on the air or off, contact Doug at his website or send him an email to doug@profile-financial.com.